Hello and welcome to the download. I'm your host, Dave Richardson, and it is the long awaited and anticipated return of Stu's Days, featuring co-head of global equities at RBC Global Asset Management, Wunderkind. I just came from Germany, by the way, so Wunderkind. Stu Kedwell. Stu, how are you doing? How's your summer going?
It's been a good summer, Dave. How about you? I know you've been on vacation. I hope it was a good one.
Well, I got to come clean. It's my fault that we didn't do. You were ready to go the last 2 weeks with another Tuesdays podcast, and I decided to do a road trip in Europe with my daughter, and then my wife came along, and we were 10 countries in 13 days, and it didn't
Wow.
leave a whole lot of time or stability to be in one spot at one time to do a podcast with you. So I apologize. It just means that things have so dramatically changed over that period that this may be the most exciting Stu's days ever. So Stu, like, just let's just go through everything that's changed. Your entire view of the market has changed over the last 2 weeks, hasn't it?
Well, Dave, I got unfortunately, I think you probably could have stayed away on vacation because it's still relatively consistent. There has been plenty of news flow.
Yeah.
You only need to kind of turn on your television each day or turn on X or whatever your source is, and there's been lots of commentary around different things. But at the end of the day, we're kind of in the same spot that we were, a couple of weeks ago, which is, the economy, shows some signs of potentially slowing, and we had a payroll number out of the United States, which, definitely showed that, although it also raised, questions about, the numbers themselves. But I think some of the public or the private surveys also had shown similar things around unemployment, and we'd seen through job openings and a variety of different indicators that unemployment was not as strong as it had been. So then you have, okay, well, the central bank in the United States in particular has left interest rates higher. You've got unemployment weakening, so can they lower interest rates? Which of course they can at some point, or they will at some point in all likelihood. But you have ongoing tariff news, which keeps inflation on the bubble a little bit, and kind of confuses that kind of dual-sided mandate that the central bank has. So the equity market is kind of taking it all in stride because the equity market says, I think that okay, tariffs can cause inflation, but it doesn't persist. It's kind of one time in nature. Unemployment is softening a little bit, but they can lower interest rates. And one thing that we've talked about before again, but I think it kind of persists is with the big beautiful bill in the United States, you do get accelerated depreciation, so you're getting more capex and you're getting a faster amount of tax refund from that capex. So the market's trying to kind of weigh all of that, and that's kind of why we still have the status quo. The other thing that does come into play this time of year is a bit of seasonality. We tend to, August and September can be a little bit tougher times on the markets, and we did hit a high in the last week of July, and then had a softer day following the payroll number, and kind of gave up most of July's gains. That's just I think kind of par for the course after the move that we had. We don't see anything kind of really interrupting it on an intermediate term basis, but in the short term, some of the indicators had certainly gotten more stretched, and we talked about that. We talked about that last time. So it's like say there's been lots of news without meaningful progress, and then within the market itself, been a bit of a narrowing, which is not always that encouraging.
Yeah.
There has been, some stocks have been a bit softer. If you've missed your earnings expectations, the punishment has been harsher than the reward for beating them. And AI has retained its kind of dominance in the stock market in the near term. So that's where we sit.
Yeah, and you kind of get that if you look at the big names, the big companies that are spending, tens of billions of dollars on AI and building out the infrastructure around AI, you expect that's got to drop into somebody's lap, and it's dropping at a good margin, and so that protects a lot of those businesses. So it's not that surprising that they're moving, and overall earnings have been pretty good, right? I think we've
Yep.
got. I think the number I saw was 60, about two-thirds of S&P 500 companies have reported, and 80% had beaten their expectations. But then, as you say, even when if they beat the expectations, but it's not super super strong, then you still have some issues, right?
Yeah, the that's what I mean. Like the numbers themselves have been okay, and even like even sometimes you get into the nuance of like a number might technically beat expectations, but the way it comes together, or one of the business metrics isn't quite up to snuff, and the reaction has been poorer in the stock market. So if we kind of looked at the skew of returns around beats versus misses, the misses have been punished a bit more significantly than the beats have been rewarded. Which again, I think I just sits to we've had a very strong move off the bottom,
Yeah.
and
Yeah.
it's just natural for there to be some sorting out. And it's been across all stocks. Even some of the Mag Seven. We've seen a very differentiated response to numbers. Some have been good and they've had follow through. Some have been good and they haven't really had follow through. So again, that's kind of the market we're in.
Yeah, and so I guess some of the things I've been saying to advisors and investors as I've been out talking to them is, it still seems like what the market is saying as you look out a little bit farther than the immediate next few weeks, is you go out a year from now, and the market's kind of saying, we expect economic growth to be a little bit better than it is right now, and we expect interest rates to be a little bit lower than they are right now, and that sets up for where you can sit today at an all-time high and still have, even in what's typically a weak period seasonally, you can still kind of chug along and chug forward, and you balance everything out. So I can sit there and I can lay the case, which was likely predominant on Friday, where, oh wow, we've got a terrible jobs report, and the previous two jobs reports that seemed pretty good, well, they weren't that good. So the employment market's tough, so the economy's slowing, and then, oh, we got an inflation report in the interim that was a little bit hotter than you would have liked, and also the tariffs are kicking in and causing the issues there on inflation, and so, oh, that looks a lot like stagflation. But then the flip side of it, as we get to Monday, is kind of, well, oh well, hey, yeah, the economy's slowing, so hey, maybe the Fed needs to lower rates a little bit more aggressively than we would have thought. And after that jobs report, some of the longer end of the yield curve, so your 10-year bond, your 30, your two, like, they all came down. And even on the rally yesterday, they didn't pop back up. So they're kind of saying things are slowing up and rates are going to be lower. And so that on Monday, the market goes back up. So it's just kind of that. It really does feel like we've kind of been treading water for a bit. And again, with all of the noise, you're still kind of sitting 2 weeks later as we are, and it kind of feels the same, and the same kind of strategies that you've been talking about still apply.
Yeah, I think so. I think like in the summertime you tend to get you can sometimes get more movement up and down than normal. We want to that's why we want to make sure, like kind of as you say, like go through some of those key categories and kind of have our view around how they might progress, rather than fitting a narrative to what's taking place on any given day. Because then you could sit there and say, well, Friday we go down, so this is now what I think. Then Monday we go up, so this is now what I think. We're just trying to be quite consistent, which is um, valuations are elevated. They're not as elevated for the average stock. Um, the yield curve, to your point around, even though we got some movement in interest rates, the slope of the yield curve is still quite positive.
Yep.
So that lends itself to the financial stocks over time. Uh, a ton of the let alone the benefits of writing off depreciation. But everything around artificial intelligence and power demand is quite good for industrials and utility stocks. That could continue. And then in the technology area, obviously, that has been very driven by artificial intelligence. So, within the portfolio, you kind of have these, four themes, and you sit there and say, well, okay, if the economy slows, then the central bank could lower short-term interest rates. That probably, may not mean that much for the slope of the yield curve, and it might just provide, more support for the themes that are already in place. Meanwhile, areas of the market that have, struggled a little bit more, like maybe healthcare or consumer staples and what have you, where, healthcare is kind of embroiled in, what is the price of drugs? There's a lot of the impact of how healthcare usage took place following COVID. You could kind of spend your life on the U.S. healthcare system if you wanted to. But how Medicare works and how many members and how much utilization and who's left and how insurance is being used, like, these have been issues that have certainly, surfaced. Let alone how much tariffs, where it's going to be produced. So the healthcare has been more of a struggle. Um, the lower end consumer is also, struggling a little bit more, not seeing the same type of income growth as the higher end. So in consumer staples land, like, you're seeing more private label, you're seeing, so you're seeing some struggles in those sectors, and lower interest rates might assist those sectors a little bit from a valuation standpoint, but they're not really likely to change the narrative around them either. So, you have this, you have a market environment where the kind of thesis that are in place are likely to persist, even if we get some volatility in this seasonally a bit more challenging period of time.
Yeah, and so you were mentioning to me in terms of your portfolio and what you and your colleagues are doing. It's a quieter period generally, but even within that, you're pretty comfortable with where you're positioned. You're not doing you're doing a little bit less than you'd normally be doing because things are just kind of chugging along, and you're pretty comfortable with how you're positioned.
Yeah, like, you're always using your dashboard for signals that are being shone in your way that say, hey, go think about this again. So that's certainly in place. But these kind of big movements in the portfolio are often sector to sector or theme to theme, name to name, that type of thing. We haven't really seen much of that. I think the one area in the portfolio that is going to be, I think, a constant kind of work in progress, even though I think some of the major themes are in place, is AI as it develops. There's going to be beneficiaries, there's going to be providers, there's going to be service providers, and I'll just give you an example of something where you might think some of the consulting businesses. There's an article on in the Wall Street Journal yesterday, but you might sit there and say, well, big companies are going to use more AI, so they're going to need help to figure it out. So that might lead its way to the consulting businesses. But then, some of the consulting businesses are proving to be a lot more productive with AI. And some of the businesses are using, some of the AIs in terms of where they may not have needed consulting to the same degree. Or, I'm going to put a new software system in, and that would have been, very, consulting heavy in the past, and now AI might be able to do some of the data transfer and things like this. So, and I'm not saying that's exactly how those situations will present themselves, but um, what we've seen is if you're a stock and you're in one bucket and you leave that bucket for some reason, it's not dissimilar to kind of an earnings miss. It is having a fairly significant impact on some security pricing. So we want to constantly be going through the portfolio and saying, like, do we have the underpinnings of this business correct, and do we need to reevaluate them?
Yeah, so maybe less activity in terms of trading positions and moving in and out of positions, but working just as hard to make sure that you're understanding exactly what you own, and is what you own going to work through what is going to be a very significant shift in the way the world operates over the next 10 years.
Yeah, no, 100%. And thankfully, this is my own, my old dividend hat as well. But uh, when it comes to banks, we see them as a beneficiary of AI. Like, big cost structures, they'll be able to be more efficient over time. Utilities, more power demand, more infrastructure development. That's not going to get replaced by AI. It's some of the services businesses where we have to really think through some of the ramifications. And we've seen it. We've seen businesses where they have an entrenched position. They do something like graphic art or something like this. Someone else comes along and begins to do the same thing, and even though it doesn't have a significant impact on the cash flow right out of the gate, it changes the valuation metric because the stock market has to say, well, there's more risk to that business than we otherwise thought. So, um, so we need to be very vigilant around how valuation might change in some of those other pockets of the market.
Yeah, well, producer Nancy added some real value to my life. We've got to get producer Nancy on with one of these times. She pulls this all together for Stu's Days. She gave me a great tip that they offer McRib in Luxembourg 12 months of the year. So I had a McRib on my trip to Europe. But the other thing she was talking about, or when we were taping with Eric Lascelles early this morning, was an app that she found where you put you put a bunch of details in and it writes a song for you. And or you get a, I don't know, you get a song that's kind of, I don't know, like a Carpenter song, like a little happy little pop song, and then you turn it into a heavy metal grunge song, and it does that for you. And like, again, just and I only illustrate that to say that, what artificial intelligence is going to be able to do. And we've highlighted it many times over the episodes on this podcast, but it just defies your own imagination. So maybe AI is the one that's going to think up all the ways it can use itself, but it
Mhm.
defies your own imagination in terms of how you can apply these tools, and then how quickly it's going to accelerate and work through the system. So the challenge for you has just got to be enormous to try and really deeply understand, if you have a significant holding in a particular company, how that's going to look over time.
Yeah, and the number one, so anytime you look at a business, the old saying is, your margin is my lunch, right? So, so companies that have big margins, these are the areas where, other competitors will try and attack and provide a similar service and kind of gain a chunk of that margin. So, when we go through all the businesses, like, there's kind of like, there's three sets of assumptions that you need to make. We've always said, buying a stock is like buying a set of assumptions. So you have an assumption about revenue, you have an assumption about margin, and you have an assumption about the valuation that resulting cash flow will trade at. So, sometimes if you see a change, revenue goes down, margin decreases, and valuation goes down. And that's where you get a significant change in the share price. Sometimes revenue and margin are fine in the near term, but the stock market worries about it. So the valuation changes as a way to try and
Triggers, yeah.
handicap that potential worry. And so the stocks that are in the portfolio, you need to go back through each of those, three sets of assumptions, and kind of re-underwrite them as time progresses.
Yeah, and as all of this has been going on, just one of the other things we touched on, as we just have a little brief discussion before we actually start putting the recording in place on the podcast. But gold as well has been an interesting play, and has done, as you were pointing out, as has certainly helped the Canadian market. But Bitcoin's fallen back. There's been a sort of a back and forth between the cryptocurrencies and gold. But when these assets are moving, it is telling you something about what's happening in the bond market, what's happening with inflation, what's happening with interest rates, what's happening with growth, and it's sending a fairly interesting message, isn't it?
Well, I think it speaks to some concerns, like that's where we'll go full circle on like what's still the same.
Yeah,
Concern around the level of government deficits around the world. Um, Lower short-term interest rates in response to slowing economy. These are a bit, maybe like years of having inflation, struggling to get inflation up to 2. Maybe now we're going to struggle to get it down to 2.
yeah.
So these are all things that are very supportive of some of these harder assets. And they too are volatile, but the trend has been upward to the right. So gold, McRib, these are all building blocks of the inflation fighting portfolio.
We're still waiting for our McRib sponsorship for the podcast, but We have not tested we will, hopefully are not going to test the McRib indicator for a while. Where again, when the McRib's offered in Canada, that's a peak in interest rates. Don't forget that for all you listeners, one of the best tips you'll get listening to this. But really, the best information you get is from the stupendous Stu Kedwell on Tuesday. Stu, thanks for joining us again, and we'll get back to our consistent most weeks on Tuesdays with Tuesdays.
Great. Thanks very much, Dave.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.